What's up, everybody? Nate here. After months of anticipation, it is finally Fed Day. On March 16th, 2022, the Federal Reserve finally announced its full plans to battle inflation in our country. This comes after inflation has consistently hit new record highs every single month. So what exactly is the Fed going to do about it? Well, the Federal Reserve approved its first rate hike in 3 years. And get this, it's going to raise interest rates 6 more times in 2022. But that's not all. They also announced plans to completely reduce their $9 trillion balance sheet that they've racked up over the last 2 or 3 years. But with the Federal Reserve finally showing us how aggressive they're going to be with inflation, the bigger question is this all going to be enough to lower inflation in our economy? And should the Federal Reserve actually be doing more to drop inflation? Well, in this video, we're going to be breaking down the Federal Reserve's brand new report on inflation. We're going to go over their full plan to combat it in 2022 and discuss if all of this is going to be enough to bring down inflation or if our economy is still going to be in shambles throughout 2022 and beyond. But before I get into all of that, do me a quick favor and hit smash or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that. And now let's talk all about the Federal Reserve and their full plan to fight inflation in 2022. Okay, so let's get right down to it. How much have they actually increased their interest rates by? Well, as of March 16th, 2022, the Federal Reserve announced that it's going to raise its benchmark interest rates from 0% by 1/4 percentage point. So all the way up to 0.25%. Now, of course, this is just a general range from the Federal Reserve. So it's around 0.25% between 0.5%. That is a pretty big increase considering that interest rates have been at 0% for the last 2 years or so. Just about everyone in the Federal Reserve approved this 0.25 rate hike, except for one. James Bullard, the St. Louis Fed president, actually was looking for a 50 basis point rate hike and did not vote in favor of this lower hike. Now, 0.25% might not be a lot, but like I said before, that's a pretty big increase considering it's been at 0. The Fed set it all the way back at 0% during the early days of the pandemic to incentivize people to go out and spend money. They didn't want demand to be eliminated in our economy. They wanted to see demand go through the roof so that way people were spending money in a time where we weren't really sure if people were going to be spending. So they made it super easy for people to get a mortgage or an auto loan or a personal loan. Pretty much money was accessible to everyone. Now that also meant that your asset markets and your housing market and auto market and pretty much every other market in the United States hit new record highs over the last 2 years. All of that money printing and dropping of interest rates meant that people were looking to make even more money because inflation was getting so out of control. Investors particularly were looking for ways to beat inflation because as the Federal Reserve printed more money, they didn't just sit on it. It didn't just stay in a vault somewhere in the United States federal government. No, this money was ultimately recirculated back into the United States economy in the form of stimulus checks and unemployment programs and the Paycheck Protection Program for businesses. So money printing then was given to people and people could do whatever they wanted with all of this cash and the majority of them went out and spent it. Now, to be completely transparent here, all of this money printing led to the United States coming out of a recession at a faster pace than we ever have in American history. Because spending from everyday consumers accounts for around 70% of our GDP, we couldn't afford for that to completely disappear. So the federal government decided to step in and just give people trillions of dollars. However, that led to high inflation because you have way more money in your economy now, which means the value of every single dollar is lower. And now you need more money to buy all of the same things because people were buying so much and demand was so high, businesses just couldn't keep up. They had to start making more, which is not free to do, by the way, and they trickled those additional costs down to consumers. Prices went up and now you have record high inflation. So essentially the Federal Reserve wants to remove that demand in 2022. They believe that our economy is in a really good place to do so. If they didn't, then they wouldn't be able to raise interest rates, because raising interest rates will lower demand. People are gonna have a hard time getting money now. And with that being said, the Federal Reserve wants to raise interest rates even more in 2022. In fact, they wanna raise rates 6 more times this year. Holy shit! Yeah, when the Federal Reserve said they were gonna get serious and aggressive with inflation, they weren't kidding. Now, these are all anticipated to be around 0.25% increases every single time, but the Federal Reserve has come out publicly and said it really just depends on how our economy is reacting to the interest rates. The last thing the Federal Reserve wants to do is completely eliminate demand and spending in our economy. So they have to be careful with how they approach interest rates in 2022. If nobody is able to get a loan and nobody is able to spend money, well, now businesses and your financial institutions, where all the money is at, are going to get hurt. That's bad in general, and it can pretty much subvert everything the Federal Reserve has done to this point, because if the economy goes into a recession or starts tanking, well, then they're gonna have to start drawing those interest rates back a little bit. With that being said, if they don't get aggressive enough with inflation, then it's just going to continue to rise, because businesses are gonna have to pay their people more, which means people have more money to spend, which means they have more money to buy things, and then businesses have to, again, make more things, which means that people have a lot less money because everything costs so much, so then businesses have to raise their wages once again. You can pretty much see how that cycle is going to continue forever. So they ultimately have to be careful here, but they're also not stopping in 2022. They want to raise interest rates again in 2023 and in 2024. 3 times in 2023 and only once in 2024. In their eyes, that should hopefully bring things down slow enough so that everything in our economy basically equals out. Prices and worker pay will be very comparable to what they were pre-pandemic. Now, what I mean by that is prices aren't really gonna go down. They're gonna stay where they're at, but people will just have more money now. The bigger difference is that prices aren't gonna get so far out of control that people need a lot more money in order to keep up with them. By the end of 2022, we could see interest rates go from 0% all the way up to almost 2%. And chances are they're gonna get even higher in 2023. So that is the interest rate side of things. But what exactly did they talk about when it comes to reducing their $9 trillion worth of assets that they've been buying on Wall Street? Well, in a statement from the Federal Reserve, they said, quote, "In addition, the committee expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities at a coming meeting." That's right, the Federal Reserve did one thing but didn't really do the other. They have brought up their interest rates, but they haven't really talked about reducing their balance sheet as of yet. When the pandemic started back in March of 2020, the Federal Reserve basically stepped in and propped up the stock market because it was tanking. Investors were pulling their money out because nobody knew what was going to happen next. They launched their quantitative easing program. That meant that they were going to be purchasing hundreds of billions of dollars worth of treasury notes, corporate bonds, and mortgage-backed securities every single month on Wall Street. And like I said before, their balance sheet is now around $9 trillion. They have been reducing the amount that they've been purchasing every single month since about November of 2021. They said that they anticipate that program ending in March of 2022, but based on this report, it doesn't seem like it's completely ending yet. What can happen is that they start reinvesting a lot of the returns that they get from those purchases. They have said that they're going to allow those assets to completely run off, so they're not going to reinvest any of their interest, and they're basically just going to sit there. But how much they're actually going to be purchasing in the future is still kind of up in the air. And the reason for this is complicated. You see, right now, the Federal Reserve has a really tough question to answer when it comes to inflation and its stimulus. The reason for this is because of the Ukraine-Russia war all the way across the planet. The stock market in the United States and markets all throughout the world are in turmoil because so many businesses have resources that are tied to Russia or Ukraine in some way. Right now, they're not really able to get all of the things that they need, meaning that they're not able to supply our economy with enough. That's a problem because you have less things, but people still willing to buy more, which equals inflation and prices continuing to rise throughout the country. Furthermore, consumers are just not going to be able to buy things because nothing is on the shelf. Even if they want to buy something, they just can't because there's nothing to buy. That is a phenomenon called stagflation. It's when inflation goes way up because you have supply chain issues and shortages, but because nobody's buying anything, your economy is losing GDP every single month. So the Federal Reserve has been really tentative to pull all of their stimulus all at once because they don't want the stock market to crash. I mean, they've been propping them up for months, pouring hundreds of billions of dollars in the market. That's basically free cash for these businesses and investors to spend however they want. Investors don't really like that. They don't want to see that money going away, but right now, it's really hard to pull all of it because the stock market is already dropping pretty rapidly. Like I said, it wasn't really clear how the Federal Reserve is going to handle this in the future, but they basically left it up in the air. They're kind of watching the entire situation right now, and if things start to get better, you can expect that money to disappear. But if things get worse, then the Federal Reserve is going to have to revert a lot of its policies, including interest rates and including its quantitative easing program. Now, what exactly does this mean for inflation in our economy in 2022 and beyond? Well, even though the Federal Reserve is raising its interest rates and potentially pulling back its quantitative easing program, you can still expect inflation to rise in the United States. The reason being is because as the Federal Reserve starts raising interest rates and eliminating some of that demand, it's going to take a while for us to see the results of that from inflation. It's not going to happen overnight because people aren't going to just stop spending money right now. It's going to ultimately lead to less spending, but not today. The Federal Reserve wants to get inflation down to around 2 to 3% by the end of 2022. And while that might be close, chances are inflation is still going to be higher than that. And you got to remember how the Federal Reserve actually measures inflation in our economy. Well, they use something called the Consumer Price Index. And more importantly, they use a metric called core inflation. Core inflation takes out all of your volatile industries when measuring price increases in the United States. So energy and food prices are immediately cut out of the Fed's gauge. The problem with that is most Americans spend most of their money on energy and food. So we may run into a situation where the Federal Reserve basically says, yeah, that inflation thing, it's going away. Look, it's getting way lower. But in reality, it's not, because the CPI is still going up, but core inflation is actually dropping. And of course, the situation between Russia and Ukraine is not going to help anything either in the short term. In fact, it's probably going to mean that inflation goes up regardless of what the Federal Reserve does. And the reason for this is because, like I mentioned before, a lot of the resources that our businesses use every single day, like precious metals, oil, and wheat, are not able to come over into the United States right now. I mean, we've placed a lot of sanctions on Russia, but they're also doing the same to us, and they're reallocating their resources to other countries that are not sanctioning them. And of course, we don't get everything from Russia, but we also have China, who is going back into economic lockdowns due to the pandemic. We get a ton of stuff from China, including wheat. If those lockdowns in China continue for a very long time, then you could continue to see inflation go up because now supply chain issues are getting even worse. And if the United States and the rest of the world goes into a full-blown energy crisis because of the Russia-Ukraine war, well, now it's going to be even harder for things to get into our country. All of that means inflation goes up regardless of what the Federal Reserve does with its monetary policy. But of course, there is a small chance that inflation could start to go down sometime soon. I mean, it really just depends on what goes on with China, Russia, and Ukraine, and the monetary policy in the United States. Spending like we have cannot continue at a healthy rate for our economy. It's eventually going to lead to a crash. Americans right now are getting into debt. While wealth has increased because of money printing and super low interest rates over the last 2 years, debt, and credit card debt more specifically, is also starting to go up. All of that gets more expensive when inflation starts to get even higher, because now you have to pay more for everything, but also you've still got to pay all of this debt off. But ultimately, if inventory starts to go up and demand starts to drop, well, that could lead to an equilibrium in just about every market, from the stock market to the housing market to what you buy on the grocery shelves. That could potentially drop inflation to the Federal Reserve's 2% mark. That is a possibility eventually, but it's most likely not going to happen in the short term. meaning prepare for prices to continue to rise. And expect inflation to continue to be a problem in 2022. This is not the last time that we're going to talk about it, and it's not the last time that the Federal Reserve is going to have to address it. But now I want to hear from you on this issue. What do you think about the Federal Reserve's brand new report detailing its full plan to fight inflation in 2022? Do you think the Fed is doing enough to battle inflation in our economy, or do you think they could be doing way more to drop inflation in the US? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.